Tobias, Carlisle today. We have Michael Bigger on Thursday. Quite exciting. I'm going to read a little bit from his quantitative value book. See, when you're old, you have to remember, did you bring your reading glasses? I did not bring my reading glasses. So let's see. So this, don't become old like me. So he's the founder and managing member of Equim Investment Management Portfolio, manager of the Equim Fund, author of award-winning website Greenblatt.com, which covers deep value, contrarian, and activist investment strategies. Extensive experience in activist investment. Actually, it's interesting. They blocked a Harvard Hall this week. They want to divest of, what do we want to divest of? I don't even know. Fossil fuels. So they want Harvard's. I don't pay attention. They want to divest Harvard's portfolio of fossil fuels, and they should have done it 6 months ago. They would have sold it at a better price. Yeah, that's true. Yeah. So he was a analyst. He's a lawyer. He's Australian. He's tall. He was a swimmer in college. All sorts of neat things. He's also in town until Thursday. So we're doing lunch afterwards. He has no plans for dinner. So if you want to bring someone to your house for dinner, he's never been to Harvard. He just finds the campus fascinating. If you want to bring him to dinner tonight, he'd be more than happy to go. So if you have a river house, you're up in the quad, you want to bring someone over for dinner, that'd be fantastic. So it's thank him for coming. Should be a fun hour talk, and we'll probably have a little time afterwards for questions. Feel free to come up and talk to him and see what's going on. So thank you very much for coming out here. And let's put this on your belt.
Testing 1, 2.
I'll make it louder. You should have a deep Australian voice. Let's see. Okay, try now.
Testing 1, 2. Can you hear me in the back?
Here, try. It should be louder.
Yep. Testing,
Yep.
1, 2. Okay. Contrarian may be the most cliched, hackneyed, moth-eaten word in all of art, literature, but certainly in finance as well, it's also the most misused. It has a very precise meaning in the literature, and that is a value investor. What is a value investor? That's someone who believes that a security has an intrinsic value distinct from its market price. And where the margin between the two is sufficiently wide, a trade can be placed long or short. And the way that the price and the intrinsic value get back together, for the most part, is a process known as mean reversion. So mean reversion means things go back to normal. In the short term, there can be a great deal of randomness in securities markets, individual securities, underlying business results. But over the long term, the underlying skill of management or expected outcomes tend to start to mirror what actually occurs. That's a calculator watch. That was the iWatch of my primary school. It was the apotheosis of cool. It's hard to understand that now, but that was pretty cool in my day. There was a famous Australian investor who had one, and when he passed away a few years ago, this came up for auction. And the price for it far exceeded what it was worth. For one thing, it didn't work anymore. So, aside from the sentimental reasons for possessing something that's owned by a famous investor, what is it that makes people pay too much for a financial asset that really should be interchangeable with the value that you have in your pocket? The reason that people do these things is behavioural. And so in order to become better investors, we need to find a way to avoid behavioural errors. And the way that we do that, excuse me, is through using quantitative and statistical methods. And we can use them in two ways. We use them in the research part of the process, which is when we're trying to determine where we should place our bets. And then crucially, and this is a part that sets me apart a little bit from other value investors, we use them in the application part of the process, which is when we actually go to place our bets, how we place our bets. As Michael mentioned, I'm Australian. I grew up in the Australian outback. I grew up on that little red dot. You can see that Australia is mostly desert. All of that yellow is desert. And the population's concentrated in the bottom right-hand corner. And on the green bits, that little red dot was about 500 kilometres away from the nearest capital city, which is about a 5-hour drive, 350 miles, something like that. That's the house that I grew up in the town of 6,000 people. They have said of this region that it was champagne country. The first explorer, when he first laid eyes on it, he'd either never been to Champagne or never drunk champagne, or he had a really good sense of humour, because it's most famous for droughts and flooding rains. I lived in Roma until I was 17 before I went away to college. And in that period of time, it was in a drought. And that house, we had the yellow that you saw on the previous screen as our backyard. In the 18 years since I've left, that house has flooded 3 times. That's an example of real-world mean reversion. On average, the rainfall is slightly less than average. But it's a little bit like the man with his head in the oven and his feet in the fridge. And they say, "How do you feel?" And he says, "On average, I feel pretty good." I studied law and business at college and practiced law in Australia and the US, and I've worked on transactions all over the world: China, New Zealand, the UK, some unusual ones like Bermuda, Guam, Papua New Guinea several times. Since I've left law, I've worked in investment, activist investment, and I started managing my own money in 2008, late in 2008, which was a very good time to start managing money. And when the market bottomed in 2009, the outperformance was phenomenal. And I thought that I was very smart for the size of the outperformance that I had delivered. And then I looked at so I like to invest in these smaller stocks for the most part. And I looked at what other small stocks had done that I didn't buy. I had done about 250% for the 9 months from the end of the first quarter to the end of the year. And I had double the performance of a similar set of stocks, but I had underperformed my screen. My screen had done 750%. So I had delivered 1/3 of what I could have potentially done if I'd just bought everything in my screen. So it led me to think that perhaps there was a better way of doing it. And I teamed up with a PhD from Booth, Wes Gray, and we went and found all of the fundamental research, all the research into fundamental business performance, value investment, credit, earnings manipulation, fraud, business quality, earnings quality, margin strength, and we built a back tester. And so we wrote about testing each individual paper and then combining them all together, and that's quantitative value. In writing quantitative value and in conducting that research, I noticed that there's this really peculiar thing, and that was that the high quality companies, the very best companies, tended to underperform the junkiest. And so that was and I just wondered what the reason was that they would do that. And so The next book is less a sort of research quantitative book and more an exploration of the mechanics of mean reversion, which I find fascinating. And so some of that work has appeared in The Introduction to Corporate Finance. That's a Canadian book. I'm guessing you don't teach that one, Michael.
We make fun of Canadians.
Yeah. And Journal of Applied Corporate Finance. So we're going to discuss 4 ideas today. The first is this deep value idea, the idea that the less good companies seem to work really well. Contrarians at the gate is about the mechanics of how that happens. Simple but not easy is how we can protect ourselves from making some of these errors, and the acquirer's multiple is my favoured metric. In the late 1920s, Benjamin Graham started teaching a night class at Columbia called security analysis. And he taught that there was this idea known as intrinsic value, and it was distinct from distinct from market price, where there was a big enough margin of safety between the two, you could buy a position, and over time, those positions would tend to outperform the market and at lower risk. In 1929, we all know that there was an enormous stock market crash. The market fell 90% from peak to trough. So you had 10% of what you had in the market in 1929 when it bottomed in 1932, which must have been terrifying. In between, Graham was almost wiped out, but he managed to keep his head, and he conducted this study in 1932 where he looked at the 600 stocks then listed on the stock market, and he observed that 200 of them traded for less than their liquidation value, which is literally going and selling the buildings and the plant and the factory, paying off all of the liabilities. You could then go and buy the residue and still make money doing it. But more interesting was that of the 600 issues, 50 of them actually traded at a discount to their net cash. So you could take the cash in the bank account, pay off all of the liabilities of the companies, and the stock still traded at a discount to that number. And so he wrote these series of 3 articles saying, this is illogical. It doesn't make sense that you can buy these stocks for so little. It either means that they're too cheap and it's a profitable area to be investing and to be studying, or it means that management's doing the wrong thing and they should voluntarily liquidate and pay the shareholders back their money. And in the process of telling this story, he came up with this iconic and enduring idea that sort of describes value investment, and that is corporate gold dollars available for 50 cents or less with strings attached. Warren Buffett has said that idea is like an inoculation. It either grabs you and it appeals to you intuitively, or it doesn't, and there's no amount of argument that can be made that will make you ever want to invest in those sort of securities. Sometime later, John Burr Williams gives us the definition of discounted cash flow, all of the cash flows in and out of a company discounted back to the present day. Everything should trade for approximately the same number adjusted for risk, lumpiness of the cash flows. So this is a study of all of the companies listed in the world with a valuation of greater than about 200 million. And we looked at price to earnings, price to book value. Book value is the residue of assets over liabilities written in the book. Price to cash flow. Take an average of those fundamental value measures and then rank every one of these 30,000 companies in the universe from most expensive to cheapest. Put them into 5 buckets, and what we find is that the one at the greatest discount to that fundamental number tends to deliver the best performance, and the most expensive one, the glamour stocks, tend to deliver the worst performance, and they perform in rank order. So Graham appeared before this Senate committee in 1955, and he was asked by one of the commissioners, what is it that makes these securities go back to their intrinsic value? How does it happen? Do you advertise or what happens? Graham gave one of the great answers that he was sort of known for, where he said, it's a mystery. It's a mystery. It's as much a mystery to me as it is to anybody else. But he was speaking about mean reversion. And what mean reversion means, and what mean reversion, what causes mean reversion to occur, is this sort of diminution of randomness over the long term, the impact of random events over the longer term. But there's also this element to it that doesn't really describe why they're at a discount in the first place. So this element of a behavioural error that allows it to drop in the first place, overreaction in the first instance, overreaction to ugly headlines or ugly results. So I like to use this little motif to sort of describe how it happens and why it is. This is Albrecht Dürer's woodcut taken from a book, Ship of Fools, where fools go to a fool's paradise and they document all of the follies of the fools in the book. And this is one of them. This is not recognising the role of luck, chance, randomness. That's the Wheel of Fortune. The top left-hand corner is Fortuna's, the goddess Fortuna's hand puppeting the wheel, because it's she who turns the wheel. There are these part human, part ass characters clinging to the wheel. The one at the very top is known as Renyo, I Rain. You can see that even though he's imminently about to descend down the other side, he doesn't recognise that at all. And he's the only one who's all ass, and he's reaching for the sun because he thinks that that's the next point that he's about to go to. Down the other side is Renyavi. He used to be where Renyo was, but now he's descending down the other side. Fallen off the wheel is Sumsina Renyo. I am without a kingdom. And that's perhaps where deep value investors want to place their bets. Or Renyabo, I will reign, which is, you can see he's turning back into the ass. He's about to get back to the top. So this is a second study by Botton Failure, who are very well-known behavioural economists. They took two portfolios. One was an overvalued portfolio measured by price to book value. The other one was an undervalued portfolio measured the same way. And they looked at the earnings trend of each of those portfolios. And it's no surprise that the overvalued portfolio has this climbing earnings over the 3 years prior to the construction of the index. The undervalued portfolio's earnings are falling. That's why it's undervalued. The interesting part, though, is what happens after these portfolios are selected. And they're selected on the basis of valuation, with the recording of the earnings trajectory just being an observation. So what happens is that the earnings of the undervalued portfolios actually grow faster than the earnings of the overvalued portfolio, and presumably the overvalued portfolio has been selected for its rapid rate of earnings growth. And the undervalued portfolio has been avoided because it looks like it's about to fall to zero. But mean reversion acts on these securities, acts on fundamental business results to turn that around. So that's a very simple analysis. This is a slightly more complex one. If you can think of 9 portfolios. I've identified the extremes of each here, but this is 9 portfolios, and they're ranked according to 2 axes. The first one is growth in earnings, and the second is price to book value discount. So the question is, does a very high rate of growth in earnings make up for very expensive stock? So that's glamour. The other possibility is you can have this very low rate of growth and you don't pay very much for it. That's contrarian value. Is the high growth value portfolio the best of both worlds? Very high rate of growth at an undervaluation. The skull and crossbones perhaps indicates that you don't want to place your bet on the low growth, expensive portfolio. These are the...
Just go back. Could you put stock names to that? What would be known stocks that are in there?
Glamour would be a Tesla or something like that.
Is Glamour Apple?
So Apple's an interesting one. Apple, for a very long time, was contrarian value. At one stage, it was the most undervalued stock in my entire large cap universe, which made no sense at all. And shortly after that, I'd discussed this with in a radio interview, where the guy had completely forgotten that at one stage there was a question about whether they'd be able to transition from one product to the next. They were very cheap. Their earnings were growing at a rapid rate, but in this particular instance, they were just too cheap to ignore. These just the detail of what we saw on the previous screen. You can see that on the left-hand side of each of those columns is the rate of growth, and on the right-hand side is the multiple that you pay for each of those fundamental. So the Glamour portfolio, for example, the earnings are growing at 18.7%, but you pay 19.7 times for them. And you contrast that with the contrarian value portfolio, earnings growing at 9.7%. That's over 3 years, so it's less impressive than it looks like. But you pay 6.5 times for it, which is very cheap by any measure. And the high growth value portfolio in the middle is sort of a marriage of both worlds, rapidly growing but cheap, and in this instance cheaper than contrarian value. So high growth value does outperform Glamour. But the question is, what is the reason for that outperformance? Contrarian value outperforms high growth value. So valuation is the driver of returns. If anything, growth should have a negative sign applied to it. This is just eliminating the Glamour, just so we can look at the two portfolios a little bit in a little bit more detail. You can see for earnings, you're actually paying slightly more. Contrarian value is slightly more expensive than high growth value. It's true also in cash flow and true also in operating earnings. The reason is that those portfolios are so ugly on a fundamental basis that their earnings are so low. So the real measure here is book value. You can see that the contrarian value portfolio is 0.2 times book. The high growth value portfolio is 0.3 times book. So the contrarian value portfolio was about 2/3 the valuation of the high growth portfolio, and that's why it performs so much better. So this is something we see over and over and over again in the literature. This is a very famous study. Tom Peters, who's a business speaker, business motivation, business strategy type speaker, he wrote a book in 1984 called In Search of Excellence, about which it has been said that it is the greatest business book of all time. I personally haven't read it for the reasons you'll see in a moment. He created these portfolios of excellent stocks, and he said these are the characteristics of excellent stocks, or this is what they tend to have on average. Very high asset growth, very high growth in equity. They're expensive, but these are other quality measures here: return on capital, return on equity, return on sales. Very high numbers. Michelle Clayman, who was an analyst, took Peter's criteria and said, what happens if we create an unexcellent portfolio? So we'll rank every stock in the universe, and then rather than taking the excellent ones, we'll take the other end of the spectrum, we'll take the unexcellent ones. And you can see that they all have low asset growth, low equity growth, fairly low returns on capital. But this is key, they're much, much cheaper. And of course, over a long enough period of time, the very, very cheap, ugly stocks tend to be the ones that outperform in a portfolio. When people see that last chart, they always say, well, is there some other advantage that you get from investing in the high quality stocks? Do they do better when the world's about to go into an ugly place? Do you want a better stock if the market's overvalued and we're heading into a depression or a recession? And the answer seems to be no. So this particular chart shows global growth above and below trend. So when global growth is above trend, the unexcellent stocks seem to do quite well. That's indicated by the white, and the shaded areas are global growth below trend. It's basically random. You tend to do as well in either state of the world. So we know that we should buy these bad stocks because they'll give us better performance. But it's phenomenally hard to do it when we're actually confronted with the reality of what we're buying when we look at them. So I'm going to go through now some of the ways that we can protect ourselves. This is perhaps the most famous study in this area, Minnesota Multiphasic Personality Inventory. When a patient presents in hospital with either psychosis or depression, it can be very difficult to make a diagnosis in the first instance. So they present, they're treated for a little bit, 2 weeks or 2 months down the road, they're reassessed and they can make a better diagnosis, psychosis or depression. So Dr. Goldstein went and found all of the inpatient records and when they were subsequently diagnosed, and he came up with this 7-question questionnaire that could be applied by psychologists when the patient presented in order to make a determination about whether they were psychotic or depressed. So his simple model outperformed even the best psychologist in backtest. So he distributed the simple model to students, those are the inexperienced psychologists, and to clinical psychologists, those are people who are practicing in the hospital and actually making the determinations. And what is interesting about this is that a student in possession of the model does better than an experienced psychologist at diagnosing either psychosis or depression. And the experienced psychologist with the benefit of the model does much better again. This is the really shocking thing. The simple model, without any discretion applied to it, does the best. So the reason that people underperform there is they're allowed to use the model and make a determination whether the outcome is the correct one or not. So this is this phenomenon that we see over and over again in the literature, and it's so much so that it's now got a name, and that's the broken leg phenomenon. And what it describes is this: you have some sort of simple algorithm for determining whether John goes to the theatre on a Friday night. It's based on rainfall or whether he's got a date. So in this particular week, you know that he has a broken leg. Your model says that he's still going to go, but the model has never considered the possibility of a broken leg. Surely in that instance, you should be able to override the output of the model and conclude that John should not go to the theatre. And the answer is no. And the reason is that experts tend to find too many broken legs. Everything looks like a broken leg that doesn't fit into the model. We override the model too frequently, and that's what leads us to underperform. So the models tend to be a ceiling for performance from which we detract, rather than a floor for performance on which we build. It's now become known as the golden rule of statistical predictive modelling, and that is that simple models outperform experts, even when the experts have access to the output of the simple models. So what that is saying is that we should follow the model, basically. But that hasn't really told us how to construct a model or what goes into the model. This is René Magritte's painting. It looks like a pipe. René underneath says, "This is not a pipe." What he's saying is that this is a painting of a pipe. And what we're looking at is a picture of a pipe, and you're looking at a picture of my screen. It's very abstracted from what it actually is. Borges has this story about an empire that valued cartography over everything else, and they wanted incredible detail in their maps. So the map grew in size until it matched the entirety of the kingdom, at which point one of the cartographers said that the kingdom itself would do nearly as well as the map at describing what was in the kingdom. What this is describing is another study. There are variations of this one, but I'll talk about college football since we're in college. A study was conducted where they took a group of students who had identified themselves as being experts in predicting the outcomes of college football games. And they took away any of the identifying information of the teams. They identified 20 bits of information that somebody could use to predict the outcome of a football game. And then they divided them into 5 groups of 4 pieces of information. So they randomly distributed these groups of information to every student who'd agreed to participate in the study. So you You might get A first, the guy beside you might get B, the girl to your left might get C. At the end of the study, though, you would have received all of the bits of information, but you're asked at each stage to determine the outcome of the football game. So at the end, there's no question that everybody's got the same information. All that is different is the order in which you've received the information. And they find this odd outcome that what happens is you tend to make your decision based on the first bit of information that you receive, and then you don't switch as you progress. So your decision is based on one thing, and then thereafter you collect information that agrees with your decision and you disregard information that doesn't. We do this every day in real life. So we need to limit the information that we seek, and we need to make sure that the rules that we apply are concrete. So a concrete rule is you and I decide that we can make a determination. If you go into a different room, you can run the calculation, or you can do whatever and we should come back into the same room and have the same answer. So that's a concrete rule. But we actually prefer rules that aren't concrete. We prefer these sort of more ornate or adorned words. There's a famous study where two students are seated looking at a screen, and they flash on the screen cells. Some are healthy, some are sick, and you have to make a determination about whether the cell that you're looking at is healthy or sick, and you don't have any training. After you've seen enough cells, and when you make your determination healthy or sick, you're given a red light or a green light that indicates that you've made the right decision or not, and you record your rules for making a determination as you proceed. The wrinkle is that halfway through the study, you're allowed to meet with the other person on the other side, and you discuss your rules. So what they've found is that one person, in this particular study, one person who's getting accurate feedback, so when they press yes or no, the red or green light actually indicates the outcome that they've found. The other student sees the same output. So they look at a red or green light based on what their partner has, their partner's information. And the student who's been getting the correct information has these fairly simple rules for making a determination about whether a cell is sick or healthy. The other student has come up with these very ornate rules for making that determination because they never get concrete feedback. When the two meet, the student who has the much more complex rules impresses the student who has the much simpler rules. So the simpler student starts taking on the rules of the more complex rules, and his results actually go down in the second part of the study. So that indicates that we have this preference for more information, and we have this preference for more complex information, even though really what we need is simple and concrete. Seth Klarman, chairman of the Bopos Group, which is based out here, I think, great investor, wrote a book called Margin of Safety, which is one of the great investment books. He says that you need to determine the few simple rules that you will apply, because in those moments of high uncertainty, that's the point that you get the low prices. And as the uncertainty diffuses and it becomes more clear what's going to happen, the prices have moved on and you've lost that opportunity. So this is one simple rule. This was one of the ones that I was talking about earlier. Net current asset value. This was Graham's rule for calculating liquidating value. Now it's quite clearly not liquidation value. He's not going out and valuing the plant or the assets. He's just saying, let's look at the most liquid portion of the balance sheet. Let's apply some simple rules and invest on that basis. So what we've found is that those very simple rules work very, very well. These are various studies. One was conducted in the US from 70 to 83. I updated it from 83 to 2010. In each instance, net current asset values massively outperformed the market. But there are some counterintuitive results when we look at these, the individual stocks in the portfolio. So the portfolios do very well, but they find that the individual stocks that the portfolios select are actually more likely to fail than the average stock in the market. So the average stock fails about 6% of the time. Sorry, net stocks fail 6% of the time. The average stock fails 3% of the time. But as a portfolio, they tend to outperform most years. This is another unusual finding. The loss-making net nets, so net nets that are actually making a loss, do better than the net nets that are profitable. And of the profitable net nets, the ones that pay a dividend underperform the ones that don't pay a dividend, all of which is sort of very counterintuitive. If we were asked what we thought, we'd probably have a preference for profitable net nets over loss-making ones, dividend-paying net nets over non-dividend-paying net nets. Warren Buffett started out as a net investor. He studied under Graham. He took Graham's rule, applied it, made a great deal of money. He didn't transition until quite a bit later in the 1970s into this franchise value investor that he is today. And so he has written extensively about his transition from one to the other. This sort of Graham net nets are also known as cigar butts. Buffett has said he's no longer going to stoop down to pick up the soggy cigar butts for their last little puff of profit. Instead, what he's going to do is he's going to buy wonderful companies at fair prices. So he describes it in the literature as high quality at fair value, which is high return on invested capital and a low enterprise multiple using earnings before interest and taxes. So Joel Greenblatt, who's another very famous investor, took Buffett's description of high quality and low prices, and he conducted a study where he said, what if we rank every company in the universe on the basis of its quality, and then we rank every company in the universe on the basis of its value? Then we sum the two rankings together, and we're looking for the highest quality at the best value, and then we'll buy the 30 that out of the 1,000 or so that we look at to determine, we'll buy the 30 best opportunities. What happens? So this is a study that we conducted in quantitative value. From 1974 to 2011, the magic formula massively outperformed the S&P 500. That's a huge margin, more than 3.5%. But the interesting thing is what the components of that strategy did. So one component was the value, which was the enterprise multiple, earnings before interest and tax on enterprise value. And the other component was return on invested capital. If he'd just selected on value alone, he'd have done much better again. If he'd selected on the basis of return on invested capital, he would have actually slightly underperformed the market. So what that's showing is that the quality measure in this instance actually detracted from the performance of the value measure. This is just the statistics of our study. You can see that the earnings before interest and tax on enterprise value outperforms on a raw basis, but really the most impressive thing is that you can see the Sharpe and Sortino ratios. It outperforms on a risk-adjusted basis too, which doesn't make a lot of sense intuitively, but it is the case. So this is what the enterprise multiple actually is. On one hand, you have enterprise value, which is sort of the full price that you pay when you acquire a stock. Market capitalization is only the equity. It doesn't take into account debt that you have to bear, cash at bank that you have access to. Preferred stock is another liability that has to be paid out, minority interests, and so on. On the other side of the equation is operating earnings, which can be defined any number of ways. EBITDA minus capex, operating income, it doesn't really matter. Michael Madison conducted this study where he looked at return on invested capital. And he said, let's take every stock, rank it by return on invested capital, divide it into 5 buckets. And this is the reason that the magic formula tends to underperform just the value metric. The very highest return on invested capital tends to return to earth. It tends to diminish, so that the dark line at the very top left-hand corner returns over time back to the pack. The very worst performing return on invested capital, which is the lighter one on the bottom left-hand corner, also tends to return. So what you're seeing when you invest in these things is growing earnings, growing return on invested capital. If you're buying the cheap ones, if you're buying the expensive ones, you're seeing it diminish. So I always like to point out that these are two examples of Regno at the top sliding down the other side of the Wheel of Fortune, and Somsino Regno, which nobody would invest in, is the one that improves. We took every single price to a fundamental ratio that you can test. We ran a value-weighted test, so that means that we treat the securities as if they're, so the S&P 500 is a market capitalization weighted index. You put more money into the bigger stocks, you put less money into the smaller stocks. That's how we conducted this test. And you can see that the acquirers multiples, whether you use operating earnings, EBIT, EBITDA, they deliver the best performance. These other metrics do just fine as well. Gross profits yield performs very well. It's just gross profits. The difference between gross profits yield and the EBIT and EBITDA is just taking out some other costs on the income statement. And the statistics as well. So not only are the raw returns better, but the risk-adjusted returns are better as well. I know that you guys had Quantopian in here recently to speak to you. This was a little collaboration I did with Quantopian where they tested my acquirer's multiple against the magic formula. It's only a 10-year data set. It's a little bit hard to read there, but it starts in about 2004 or 5. I've highlighted the relevant portions, but the magic formula is in yellow. The acquirer's multiple is in red. Even though it's been a fairly difficult 10 years for value metrics, it's still outperformed on a raw basis. Not so on a risk-adjusted basis over the last 10 years, but true on a raw basis. So this is the most interesting part of the magic formula discussion. So Joel Greenblatt, who came up with the magic formula, had a way to test in his own firm whether people who applied the magic formula with or without discretion, so whether they were forced to apply the model or not, whether they would outperform, by creating two options for people when they signed up. You could take the output of the magic formula and select stocks from it, ignore the ones that you didn't buy, and then they would fill a portfolio for you. Or you could just have them do it automatically. So what they found is that the automatic accounts that applied the magic formula massively outperformed the S&P 500 over a 2-year period. And then just as you would expect, the investors who took the magic formula, which we know worked over that period of time, and used their discretion to cherry pick out the stocks that they thought were going to be losers, tended to underperform. So that's Joel Greenblatt's. Some people say, well, that was lay investors who were applying the rule, but Greenblatt says exactly the same thing. They tried to do it as well, and he describes a story of picking out this particular stock that he knew was no good because it was a pharmaceutical company that was coming off patent. And of course it got bought out when he didn't put it in, and so his portfolio underperformed where it would have if he hadn't cherry-picked it out. So the 4 ideas that we've covered today, I favour deep value, which is sort of a valuation type approach rather than looking at high growth and quality. The expectation of mean reversion is more powerful than naive extrapolation, which is assuming that a trend will continue. Simple models, even though we don't feel particularly smart when we use them, and we prefer complexity, tend to outperform experts, and the acquirer's multiple of all of those metrics tends to be the better metric. This was Tom Keene. This is my most recent book. It came out in August last year. It covers most of the ideas that we've discussed today. If you're interested in learning more, I have a little site called theacquirersmultiple.com. You can get free stock picks on that based on the metric that I showed you before. I have a blog at greenbacked.com. I'm on Twitter at greenbacked, and I have another site called Singular Diligence. for professional investors. But if you have any questions, I'd be happy to take them.
So I'll start with two. So if you're looking at, say, Yahoo, the key statistics on Yahoo, is there one metric you would look at for any stock?
Enterprise value, enterprise multiple.
I'm sorry?
The enterprise multiple,
Enterprise multiple.
which Yahoo Finance does record for you. I don't know how accurate they are because there are often lots of errors in those. But you can take that number and then you can look in the most recent 10 Q or K, and you can use the calculation that I have in that presentation and calculate it. And
so if you go with that, Tesla looks horrible.
It's on like 1,000 times when what you want to buy is something on 5 times or less.
And you didn't mention dividends. Do we care about dividends?
Well, I mentioned them in the context of the net investing. So dividend paying stocks as a cohort outperform non-dividend paying stocks. But then within the dividend paying stocks, if you then rank from the lowest dividend yield to the highest dividend yield, there's really no rhyme or reason to it. It's sort of, it's not a great indicator. So what a lot of quantitative investors do who are looking for income type stocks is they say, well, we'll just eliminate all of the non-dividend paying stocks. We're only going to look at the dividend payers. And then we're going to rank on another metric like price to earnings, the acquirer's multiple, price to book. And that's how we'll identify the dividend payers that we want to buy.
Anything else? Well, we thank this